What are the top money market funds in our community yielding? And are you paying more taxes on your cash than you should? Hello, members, super savers, and bond course fans. I hope you're healthy and well. This is the money market fund update that many of you have requested. And specifically, here are the 3 topics that we'll be covering in today's video. 1. How do the top Fidelity, Schwab, and Vanguard money market funds that interest our Diamond NestEgg community compare in terms of yield and tax treatment? It seems that quite a number of savers do not realize that some money market returns can be taxed differently depending on the state you live in, as well as the type of account that they're held in. In this section, I'll also let you know which ones you can and cannot buy via your E-Trade account online. 2. Why do we generally park our excess cash in T-bills versus money market funds these days? And 3. What other factors might you want to consider? Also, for those of you who subscribe to Your Financial Journey, Caitlin and Ava have incorporated some of the suggestions you've sent their way, so stay tuned. I'll share with you towards the end of this video what they've just kicked off over there today for the younger people in your lives in honor of Financial Literacy Month. As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. How do the top Fidelity, Schwab, and Vanguard money market funds that interest our Diamond NestEgg community compare in terms of yield and tax treatment? So let's do this alphabetically with our brokerage firms, and first go through the 6 Fidelity money market funds that our community is talking about and investing in the most. Then we'll cover the Schwab ones, and last but not least, the Vanguard ones. For Fidelity money market fund comparison, we have SPAXX, SWVXX, FDRXX, and FDLXX, as well as FZDXX, which has a $100,000 minimum investment requirement. And because it seems that some of you have a fair bit of dry powder parked in money market funds these days, we've also added FMPXX, which has a $1 million minimum investment requirement. Do note that the first 4 on this list are government and treasury money market funds, and the last 2 are prime money market funds. Government and treasury money market funds are most comparable to T-bills in terms of risk-return profile, in that they invest mostly in treasuries and other U.S. government debt securities, such as agencies. Prime money market funds, on the other hand, while still considered safe relative to other asset classes, tend to have a slightly higher risk-return profile than their government and treasury counterparts. In other words, prime money market funds will generally have a bit of a higher yield relative to government and treasury money market funds because they do not just hold government and treasury securities in their portfolio. They may also hold securities from domestic and foreign corporations as well as financial institutions. If you want more details on the different types of money market funds out there, check out this money market funds overview here. I've also linked it in the first pinned comment below for your convenience. So in this column, we have the name of the fund. In this column, we show you whether the money market fund is a core money market fund. A yes here means that the fund is a core money market fund, and you can tell Fidelity to automatically sweep any excess cash that you have in that brokerage or retirement account into the fund. And when you make a purchase, Fidelity will also automatically pull cash from the fund first if needed. You do not have to place an explicit buy or sell order in such cases. Do note that while SPAXX is available as a core money market fund for practically all retail account types at Fidelity, FZFXX and FDRXX may only be available for some types of retail accounts at Fidelity, such as IRAs and HSAs. And a no here means that the fund is not a core money market fund, and you cannot tell Fidelity to automatically sweep any excess cash that you have in your brokerage or retirement account into the fund. You have to place an actual order to buy the fund. In the event that you're ever short on cash when you place an order to buy a bond or stock, Fidelity would first pull the necessary funds from your core money market fund, so one of these here. Then it would pull the necessary funds from your non-core taxable money market funds, so one of these here. starting with the non-core taxable money market fund with the highest balance and ending with the non-core taxable money market fund with the lowest balance. Meaning that even if you did decide to park your cash in FDLXX, which is not a core fund, you wouldn't necessarily have to sell shares of FDLXX beforehand if you wanted to place an order to buy a bond or stock. Fidelity would do it for you automatically on an as-needed basis. And if you're still short on cash, once Fidelity has pulled everything out of your core money market funds and non-core taxable money market funds, then Fidelity would pull the necessary funds from your non-core tax-free money market funds. Again, starting with the non-core tax-free money market fund that has the highest balance and ending with the non-core tax-free money market fund that has the lowest balance. Now, let's move on to the next column, the 7-day SEC yield at the time of this taping. Remember that the 7-day SEC yield is based on the last 7 days' performance of a money market fund, hence the name. But this is then converted into an annualized rate net of expenses, but before taxes. So the 7-day SEC yield should give you a good indication of how a money market fund investment has been performing for you on an annualized basis after cost. The 7-day SEC yield for these Fidelity government and Treasury money market funds is more or less the same, with the exception of FDRXX, which is slightly higher at the time of this taping. This is not always the case. FDLXX has the lowest 7-day SEC yield of all the funds on this table, but it may still be attractive for some investors, so don't write it off yet completely. More on this shortly. FZDXX and FMPXX have higher yields, which, as we discussed earlier, is primarily driven by the fact that they are prime money market funds that hold more non-government and non-treasury securities in their portfolio. And in this column is the percentage of eligible income from U.S. government obligations in 2023. And the last column is the percentage of eligible income from U.S. government obligations in 2024. Because these money market funds invest a part of their portfolio in U.S. government securities, some of the interest they earn on their investments may be exempt from state and local income tax, as U.S. Treasuries generally are, which means that some of the dividends paid out to you from these funds may also be exempt from state and local income tax. In other words, these two columns may also be read as showing the percentage of the dividends earned from the respective funds here and in the respective years here that may be exempt from your state and local income and or investment taxes as a result of the U.S. Treasuries that the funds hold. And if you live in a high tax state as we do, this can be a potentially quite attractive feature. So if we look at SPAXX here, if you had earned $100 in total ordinary dividends from SPAXX in 2024, 55.09% or $55.09 of the total ordinary dividends earned may be exempt from state and local taxes. Now, you may notice this asterisk here. This is to note that the percentages here do not apply to California, Connecticut, and New York taxpayers who own these funds in these specific years. California, Connecticut, and New York exempt dividend income from their state and local taxes only when a fund has met a certain minimum investment in U.S. government securities, generally around 50%. And some of these money market funds did not meet the minimum investment in U.S. government securities required to exempt the distribution from state and local taxes in California, Connecticut, and New York, which means that you'll have to pay full state and local taxes even on the proportion of your money market dividends that reflect income derived from U.S. Treasuries. So basically, if you live in California, Connecticut, or New York, this entire column was irrelevant for you in 2023, unless you owned FDLXX in 2023, in which case 90% of the total ordinary dividends earned in 2023 may have been state and local tax exempt. And yes, this high percentage of eligible investments is the special advantage of FDLXX that may make it attractive to some investors, as I mentioned before. And this column would be mostly irrelevant for California, Connecticut, and New York residents for 2024 as well, unless you own SPAXX, FDRXX, and FDLXX, in which case 55.09%, 57.19%, and 97% respectively of the total ordinary dividends earned in 2024 may have been state and local tax exempt. Now, these numbers change every year as the funds adjust their portfolio, as you can see. And specifically for our California, Connecticut, and New York savers, you should know that FDLXX is the only money market fund on this list that appears to consistently from one year to the next to have a high enough percentage invested in U.S. government securities to make the dividends earned from it mostly state and local tax exempt. This is not always the case for SPAXX and FDRXX. If you want more details on these numbers here, I've linked Fidelity's supplemental letter with this information in the first pinned comment below for your convenience. So that was Fidelity. Here's our Schwab money market fund comparison of SWVXX, SNVXX, SNOXX, and SNSXX. You'll notice the investor in parentheses here. Schwab's money market funds have two share classes. All of these here are investor shares with a $0 minimum initial investment. And these are the Ultra shares with a $1 million initial investment. The Ultra shares have a 7-day SEC yield that is typically 15 basis points more than their investor share equivalent. Also, do take note of the no's in this core fund column. The reason for all these no's here is that Schwab has eliminated sweep money market funds as a cash feature for most new and existing accounts. I believe this happened in 2018, and what it means is that you do have to always place an actual buy or sell order for each of these money market funds here if you have a non-margin account with them. Automatic sweep is not available. Otherwise, this paltry 5 basis points is what the uninvested cash in your Schwab brokerage account is earning at the time of this taping. And as with our Fidelity comparison, if you live in California, Connecticut, or New York, this column here with the percentage of eligible income from U.S. government obligations in 2023 and 2024 is irrelevant for you unless you own either SNSXX or SUTXX, in which case nearly 100% of the total ordinary dividends earned in 2023 and 2024 may have been state and local tax exempt. So that was Schwab. Now let's move on to our Vanguard money market fund comparison of VMFXX, VMRXX, and VUSXX. All three of these are government and treasury money market funds, as Vanguard does not offer any prime money market funds. VMFXX is Vanguard's core settlement fund, where any excess cash that you have in your brokerage or retirement account is automatically swept into. Vanguard will also automatically pull cash from the fund if needed. You do not have to place an explicit sell order in such cases. For VMRXX and VUSXX, though, you would have to place an actual buy or sell order, and there is a $3,000 minimum for the initial investment for both of these money market funds. The 7-day SEC yields for all of these funds is relatively similar, as you can see here, and generally higher than the yields on Fidelity's government and treasury money market funds, as well as Schwab's here, that do not require a minimum initial investment of $1 million. And the reason for this is because of the generally lower expense ratios that Vanguard charges on its money market funds. Again, as with our Fidelity and Schwab comparisons, if you live in California, Connecticut, or New York, this column here with the percentage of eligible income from U.S. government obligations in 2023 is irrelevant for you unless you owned VUSXX in 2023, in which case pretty much 80% of the total ordinary dividends earned in 2023 may have been state and local tax exempt. In 2024, though, all three of these money market funds met the minimum threshold of U.S. government securities held in their portfolios to qualify for the tax exemption in California, Connecticut, and New York, meaning that no matter which state you lived in, if you owned VMFXX in 2024, 59.87% of your total dividends earned may have been state and local tax exempt. If you owned VMRXX in 2024, 63.61% of your total dividends earned may have been state and local tax exempt. And if you owned VUSXX in 2024, 100% of your total dividends earned may have been state and local tax exempt. For the E-Trade fans in our community, you can purchase Fidelity's SPAXX, FDRXX, FDLXX, FZDXX, and FMPXX in your E-Trade account online. For SPAXX, FDRXX, and FDLXX, the minimum initial investment requirement is $1. For FZDXX, the minimum initial investment requirement is $100,000, as it is for Fidelity's own customers. And for FMPXX, the minimum initial investment requirement is $1 million, also the same as for Fidelity's own customers. SWVXX is the only one that came up as being not available for purchase through E-Trade. All of these Vanguard money market funds are also available for purchase via your E-Trade account online, with a minimum initial investment requirement of $3,000 for each fund. Marcus actually holds VUSXX as his money market position at E-Trade. And none of these Schwab money market funds are available for purchase via your E-Trade account online. So if we look at our comparison of these funds, what we can see here is that while the 7-day SEC yield is important, it's not the only factor to consider. The state you live in may also significantly impact your money market fund choice. If you live in California, Connecticut, or New York, for example, and you're parking your cash in a normal taxable brokerage account, you may well want to consider FDLXX, because even though the yield is similar to these other money market funds, 90% or more of the total ordinary dividends earned may be state and local tax exempt year after year. Or SNSXX or SUTXX if you're a Schwab customer, because nearly 100% of the total ordinary dividends earned may be state and local tax exempt year after year. Or VUSXX if you're a Vanguard customer, because about 80 to 100% of the total ordinary dividends earned may be state and local tax exempt year after year. But of course, always make sure it fits your personal circumstances, goals, and expectations. And with that in mind, let's move on now to the next section of today's video. Why do we generally park our excess cash in T-bills versus money market funds these days? As many of our Diamond NestEgg regulars already know, a majority of our portfolio is with Fidelity. And while I am a Fidelity fan overall, I've been with them for about 30 years. Fidelity does have some of the lowest 7-day SEC yields on their money market funds, as you can see here, primarily because the expense ratios on their money market funds are generally higher than Schwab's and Vanguard's. This didn't matter as much when T-bill and consequently money market rates were higher in 2023 and 2024. But the lower rates go, the more it does matter. And that's why we've moved back to parking most of our excess cash in 4-week T-bill ladders rather than money market funds. Here's where T-bill rates closed at the time of this taping. So the 4-week T-bill is still more than 10 basis points higher than even Vanguard's money market fund rates here. Add in the fact that we live in New York, a high tax state, and that we hold most of our T-bills in normal taxable brokerage accounts. And the decision for us is clear because interest earned on T-bills is subject to federal income taxes only and 100% exempt from state and local income taxes, unlike the dividends earned on these money market funds. And yes, we would have gotten a similar state and local tax exemption in 2024 had we held FDLXX, where 97% of the total ordinary dividends earned may have been state and local tax exempt. But the yield on FDLXX versus holding T-bills directly just doesn't make this worth it. And the dry powder that we do want to keep as liquid as possible, because you just never know when a good investment opportunity or an emergency comes around, we've simply moved over to E-Trade, where we have some old accounts from a previous life. And that money we park into VUSXX, as I mentioned earlier. This gives us both a higher yield and flexibility. Of course, that's us. And as I always say, everyone's financial journey is different, which brings us nicely to the next section of today's video. What other factors might you want to consider? So far, we've shown you that whether you would earn more money by parking your cash in T-bills versus a money market fund will depend not only on the yield, but also on the fund's percentage of eligible income from U.S. government obligations and the state that you live in. For example, I know that some of the savers in our community live in no or low tax states, so they don't really care that T-bills are exempt from state and local income taxes. So this last column here may not matter much or at all to them. Another consideration is the type of account you're holding your money market funds and T-bills in. I've focused mostly on normal taxable brokerage accounts so far. But if your focus is on retirement accounts, then how money market funds and T-bills are taxed may also be much less important, because the earnings from both types of securities, from all types of securities held in your retirement accounts for that matter, will be taxed in the same manner upon distribution, based on the tax rules that apply to those types of retirement accounts. Please consult with your tax advisor if you want to go deeper into the tax aspects we've highlighted in this video. And last but not least, also consider how much liquidity you need and how comfortable you are with buying treasuries on your own. It may be that you simply prefer the liquidity of money market funds, or perhaps you're just uncomfortable with buying and or laddering T-bills. Which brokerage firm or firms are you with, and what's it for you? T-bills, money market funds, or a combination of both? Drop a comment below and let everyone know. And as always, if you do want to get comfortable with buying and laddering treasuries while rates are still quite attractive, then check out this video here on our bond courses. And for those of you who follow your financial journey and asked about personal finance videos for the younger friends and family members in your life, check out the first video for Financial Literacy Month from Caitlin on the 8 golden rules of personal finance. Caitlin and Ava have set a rather ambitious goal of 1 video per day for April to celebrate Financial Literacy Month. Hopefully, their videos on saving, budgeting, and debt will help the kids, grandkids, and other loved ones in your lives with their financial journey. In fact, from the sneak peek they gave me, there might be some fun and interesting videos for all of us, even me, if I dare say. So be sure to hop on over, check out what they've planned for the next 30 days, and definitely share with those who you feel might benefit from learning more about the fundamentals of personal finance. I've also linked all the details on Caitlin and Ava's channel, our bond courses, and YouTube Super Saver membership below this video for your convenience. All right, members, Super Savers, and bond course fans, I hope you enjoyed this video and learned something new. And see you again very soon with more brand new wealth building content for your financial journey.